more than $1.2 trillion. That is what more than 41 million Americans owed in student loan debt when the Consumer Financial Protection Bureau counted it in its Student Loan Servicing Report of 2015. That makes it the second largest class of consumer debt behind only mortgages. And here's the part that surprises people. What you owe is never only what you borrowed. Interest sits on top of it. Interest that quietly accrues from day one. Interest that makes you pay back much more than you ever took out. So this video answers one question: how much does the interest actually add, and what decides whether that number is small or ruinous? Think about the last time you borrowed money. Maybe for a car, maybe a credit card. The interest was on the bill, clear as day. But student loans work differently. The interest starts accruing the moment the loan is issued. Not when you graduate, not when you get your first job, from the day the money hits your account. And for many, that's years before you start paying. That gap is where the trouble begins. The usual advice says, choose a longer repayment plan to lower your monthly payment. That sounds helpful, but it means you pay interest for many more years, and stretching the term is the fastest way to double the interest bill. This video will change how you see your student loans. It'll show you exactly how interest piles up, and the repayment options that can save you thousands. You'll walk away knowing the questions to ask, because the system is built to be confusing. But you don't have to stay confused. When you take out a student loan, you get the principal. That's the amount you actually borrow to pay for tuition, books, maybe living costs. But from that exact moment, interest starts to accrue. Accrual just means it's adding up. The clock is ticking, even while you're in school, even during the grace period after you leave. Unless you have a subsidized loan, the government pays that interest for you during certain periods. But for unsubsidized loans, the interest is yours. It's like renting money. You pay for the privilege of using it. Let's make it real. Say you borrow $10,000 for your last year at a rate of 3.65%. During the first year, while you're still in school, about $365 of interest accrues. So by the time you start repayment, you owe $10,365. You've already paid $365 for nothing. And this is just the start. The interest doesn't wait for you to have a job. It doesn't care if you're still studying. It just grows. And if you don't understand this, you'll be shocked when you see your first bill. That's why so many borrowers are caught off guard. They think the loan starts when they graduate, but it starts the day they sign. So when you borrow, remember, you're not just borrowing the tuition. You're borrowing the interest that comes with it. Now the real trouble begins when you start repaying. Your monthly payment is split between interest and principal. At first, most of your payment goes to interest. The principal barely moves. And because interest is calculated on the remaining balance, it stays high for a long time. Think of interest as rent charged on money you already owe. The rent comes out of your payment first, every single month, and only what survives that reaches the balance. Pay the minimum, and almost nothing survives it. And here's the kicker. If you pause your payments through deferment or forbearance, the interest that piled up while you weren't paying can be added to your principal when the pause ends. That's called capitalization. Now you're paying interest on interest. It's the same trick that makes credit card debt painful. But with student loans, it happens quietly over decades. That's why the total you pay back can far exceed what you borrowed. And capitalization is the part that catches people, because it is silent. Nobody sends a letter saying your principal just went up. It shows on a statement months later, as a balance that is larger than the one you remember, on a loan you have been paying every month without missing. The single most useful thing you can do is keep unpaid interest from ever reaching that point. Let's put real numbers on this. Suppose you borrow $10,000 at a 3.65% interest rate. That's actually a pretty low rate. Over a 10-year repayment, you'll pay back more than you borrowed. Let me break it down. The monthly payment on that loan is about $100. Over 120 months, that adds up to just under $12,000. But you only borrowed $10,000. So you're paying about $2,000 in interest. That's 20% extra. Now imagine your rate is twice as high. At 7.3%, the same loan costs a little over $14,000. The difference is staggering. And that's just a small loan. Many people borrow way more. Scale it up. On a $30,000 balance at that same 3.65%, 10 years of repayment costs close to $6,000 in interest. It's not a small fee. It's a major part of the cost of education. And the term is the lever. Stretch that same $10,000 loan from 10 years to 20, and the interest roughly doubles, from about $2,000 to about $4,000. Same loan, same rate, twice the interest, bought with time. So when you're deciding how much to borrow, remember, every dollar you borrow will cost you more than $1 to pay back. And the higher the rate, the more it costs. So borrow only what you need, and try to pay it off as fast as you can. In 2024, federal student loan rates jumped. The rate on new undergraduate loans hit 6.53%. That's a 19% increase from last year, and it's a 44% increase from just 5 years ago. That's the highest level in over a decade. For a student leaving school in 2025, a loan for the final year of college will cost $466 more than the same loan taken just 1 year earlier. That's a single year's difference. Imagine the impact over a full degree. This isn't a hypothetical. It's happening right now. And it means every dollar you borrow today is more expensive than it would have been a few years ago. So the timing of when you borrow matters, and the amount you borrow matters more than ever, because at these rates, interest adds a third or more to everything you hand back. Let's put it in perspective. If you borrow $30,000 at 6.53% over 10 years, you'll pay back over $40,000. That's $10,000 in interest. That's a huge chunk. And if you stretch it to 20 years, you'll pay even more. So higher rates mean you need to be even more careful about how much you borrow. And you need to have a plan to pay it off, because the interest won't go away. It just gets bigger. You're not alone in this. In its 2015 report on student loan servicing, the Consumer Financial Protection Bureau estimated that more than 1 in 4 student loan borrowers were delinquent or in default. That means they're behind on payments or have stopped paying altogether. And a recent survey found that 63% of borrowers have had difficulty making payments. 37% have missed at least one payment. 30% have gone without food, medicine, or other necessities because of their student loan bills. Let that sink in. Nearly a third of borrowers have had to choose between paying their loan and buying groceries. That's not a small group. That's millions of people. The system expects you to pay. But for many, it's impossible. The next section will show why so many end up in this situation, and what you can do to avoid it. But first, understand that if you're struggling, you're not alone. There are options, but none of them come looking for you. Because ignoring the problem only makes it worse. Default can ruin your credit. It can lead to wage garnishment. It can follow you for years. So don't let it get that far. If you're having trouble, there's help. You just have to ask. Here's a misunderstanding that costs people thousands. Many borrowers think the standard repayment plan is the only choice, but that's not true. 42% of borrowers report only ever using the standard plan, and 21% don't even know if they've ever chosen a different one. Among those on the standard plan, 31% say they didn't know they could pick another, and 14% say they need help or more information. That means a huge number of people are paying more because they don't know their options. The federal government offers income-driven repayment plans. These base your monthly payment on your income. If you earn little, your payment can be as low as $0. And these plans end in forgiveness of whatever is left after a set number of years, though the exact term depends on the plan and on the rules in force when you sign up, so check the current terms before you count on it. That's a game changer for many, but you have to know it exists, and you have to choose it. The standard plan is just the default. It's not the best for everyone. If you have a low income, an income-driven plan can make your payments manageable, and it can prevent default. So don't assume the standard plan is your only choice. Take the time to explore your options. It could save you thousands, and it could keep you out of financial trouble. So how do you use this knowledge? Every dollar above the minimum goes straight to the principal, and the principal is what the interest is calculated on. So an extra payment shrinks the bill twice. Add $20 a month to that $10,000 loan, and you would save hundreds in interest and clear it months earlier. If the minimum itself is out of reach, an income-driven plan sets the payment against what you actually earn, which frees up cash now at the cost of more interest later. Worth it as a safety net, expensive as a habit, unless you are working toward forgiveness. What does not work is silence. Deferment and forbearance still accrue interest on most loans, and a servicer cannot offer you anything you never asked for. None of it is automatic. The balance, the rate, the plan you are on, all three are sitting behind a login you probably have not opened since the loan was disbursed. Student loan debt doesn't just affect your bank account, it affects your future. Research shows that a 10% increase in student loan debt causes a 1 to 2 percentage point drop in homeownership rates. That's during the first 5 years after you leave school. And a survey found that 44% of borrowers delayed buying a home because of their student loan payments. Think about that. Almost half of borrowers are putting off one of the biggest financial milestones. And it's not just homes. The burden can delay starting a family, saving for retirement, or investing. It's like carrying a heavy backpack that slows you down. Every step is harder, but understanding the costs can help you plan. You can make smarter borrowing decisions now to avoid these delays later. For example, if you have $30,000 in student debt, a 10% increase would be $3,000. That might not sound like much, but it could reduce your chance of owning a home by 1 to 2 percentage points. That's a real impact. So when you're thinking about borrowing, consider the long-term effects. It's not just about the monthly payment. It's about your ability to reach your goals. For 3 years, federal student loan payments were paused, and that pause taught a lesson nobody meant to teach. A debt you are not paying does not stop existing. So a borrower who took the pause as a break came back to a debt that had waited, patient and entirely intact. Nothing went wrong. No payment was missed. The bill simply returned to a life that had spent 3 years rearranging itself around not paying it. That is the property of debt that costs people the most. It does not need your attention to keep existing. This is why you need to be prepared for the real cost from the start. Don't rely on pauses or forgiveness. They're not guaranteed. The only thing you can control is your understanding of the loan. So take the time to learn how interest works and make a plan that you can stick with, because the pause is over and the bills are back. Call her Maya. She took out a $10,000 loan for her final year of college. The rate was 3.65%. She figured she'd pay it back quickly. She got a job after graduation, but she only made the minimum payment. Every month, she sent in about $100. She watched the balance drop, but slowly. After 5 years, she'd paid just under $6,000. About $1,400 of that had gone to interest, and the balance still sitting there was around $5,400. Half a decade of payments, and she was barely past the halfway mark. Maya didn't understand the mechanics until she looked at her statement. The interest had been eating her payments. She finally sat down and did the math. Over 10 years, she'd paid just under $12,000 for that original $10,000. That's nearly $2,000 in interest, about 20% more than she borrowed. She wished she'd known about income-driven repayment, but she only found out later. An income-driven plan would have lowered her monthly payment, but it would not have lowered her total cost. A smaller payment stretched over more years means more interest, not less. It is a cash flow tool for when the minimum is genuinely out of reach, not a way to pay less overall, the one exception being when a forgiveness clock runs out, while a balance is still standing. What would actually have cut Maya's bill was the opposite move, paying more than the minimum, so the extra lands on the principal. But she didn't know, and no one told her, so she kept paying the minimum, and the interest kept growing. She did everything the loan asked of her. She made every payment. She never defaulted, and she still handed over about $2,000 in interest, which was the price of the loan, not a penalty for a form she never filled in. In October of 2023, about 40 million Americans opened their mailboxes to find a bill they hadn't seen in 3 years. Federal student loan payments had resumed. For many, it was a shock. Some had used the pause to save. Others had built a life around the money the payment used to take. The pause had been a lifeline. But it was always temporary. When payments restarted, the reality of the debt came back. For many, the shock was not the size of the balance, but the size of the gap it left in the budget. The pause was a rare gift, and it changed nothing about the debt underneath it. The money was still owed, in full, on the day the letters went out. And when the pause ended, millions were faced with a bill they couldn't afford. Some had to make tough choices, others fell behind. In its 2015 servicing report, the Consumer Financial Protection Bureau estimated that more than 1 in 4 student loan borrowers were already delinquent or in default, and that was years before the pause ever began. That's a lot of people, and it didn't have to be that way. If they had known about income-driven repayment, they could have lowered their payments, but they didn't know, and they paid the price. Interest starts accruing the day your loan is issued. That's the first thing to remember. The longer you take to repay, the more interest you'll pay. If you can, choose a plan that lowers your payments without stretching them too long. Income-driven repayment can be a lifeline, but it's not the only option. Always compare. And if you're struggling, don't hide from your loans. Contact your servicer and ask about your options. They might offer forbearance or deferment, but know that interest can still accrue. The best move is to pay more than the minimum when you can. It cuts your total cost. And remember, student debt can delay big life goals like buying a home. So understand the true cost before you borrow, and make a plan that fits your life. If this video helped you see your student loans differently, hit the subscribe button. It helps me make more videos like this. And leave a comment. Look at your own loan statement today. What interest rate are you paying? Share it in the comments. It takes less than a minute, and it might just be the first step to saving thousands. Thanks for watching.